Hi, there has been a lot of talk lately about silver being finished, silver being tired, silver being somehow dead, because American retail demand does not look like a stampede right now. So, in this video, we are going to separate the retail noise from the actual silver market, and you are going to walk away feeling a lot clearer about what is really happening. Today is Sunday, April 26th, New York date, and I want you to comment what day and date you are watching from. And if you value this kind of breakdown, support the work by subscribing and commenting John A.G. Best. So here is the claim. Coin shops are quieter. Some dealers are seeing more sellers. Some premiums have cooled. Some stackers are frustrated. Therefore, silver must be dead. Okay, that sounds convincing on the surface. But once we break it apart, it is not really a silver argument. It is a retail argument, and those are not the same thing. Silver is not just the person walking into a local shop with a few rounds in a tube. Silver is solar panels, electronics, grid equipment, vehicles, medical devices, jewelry, coins, bars, exchange inventories, imports, exports, vaults, refineries, and global capital looking for somewhere to hide when paper promises start feeling thin. That is a much bigger bathtub, so if one little faucet slows down, you do not immediately say the ocean disappeared. Now, to be fair, American retail demand matters. It can tighten dealer shelves. It can push premiums higher. It can create delays. It can bring emotion into the market. And yes, when retail buyers disappear, you can feel it in certain parts of the physical market, but feeling it does not mean it controls everything. That is the key distinction. Based on recently published numbers, total silver demand has still been sitting around the 1 billion ounce neighborhood, give or take, while industrial use remains one of the largest pieces of the market. Even after a recent pullback, industrial fabrication was still running in the mid-600 million ounce area, which is enormous compared with the slice most retail buyers are arguing about. So when somebody points at one coin shop and says, look, nobody wants silver, I hear the same problem every time. Wrong denominator. They are comparing a local retail mood against a global supply chain. And that is how people get tricked, because coin shops are visible. You can film them. You can interview the owner. You can ask whether people are buying or selling. That feels real because it is real. But real is not the same as complete. A grocery receipt is real too, but it does not tell you the whole economy. Same thing here. You can have more sellers than buyers by head count and still have buyers taking down more metal in dollar terms. 10 people can sell small amounts, and one serious buyer can quietly absorb more than all of them combined. So the question is not just how many people are selling. The question is how many ounces are actually leaving weak hands, who is buying them, and whether the metal is being redistributed from nervous retail owners to stronger hands. That is a very different story, and honestly it may be the more important one. Because if silver can hold strong while casual retail sentiment is weak, that tells us something. It may tell us the market is being supported by forces that are not showing up on the front counter. Now this is where American investors have to be careful. We live inside our own information bubble. We see American videos, American shops, American comments, American premiums, American frustrations. Then we accidentally call that the silver market. But the silver market is not just America. It is India buying jewelry and investment metal when price psychology shifts. It is China dealing with industrial demand and physical premiums. It is manufacturers trying to secure supply. It is miners that cannot magically increase output overnight. It is refiners, traders, and investors watching the same deficit conversation build year after year. From recent market updates, silver has been discussed as moving through another structural deficit, even with some demand categories cooling. That is important. A market can have soft spots and still be tight overall. That is exactly where lazy headlines fail. They want one sentence. Silver is dead. Silver is going vertical. Retail is gone. Retail is back. But markets do not work like that. Markets are messy. They have cross currents. And silver, more than most assets, loves to make people uncomfortable right before it does something interesting. Now, there is a counterpoint here, and we should not ignore it. If American retail demand stays weak for a long time, that can matter. It can cap premiums. It can reduce excitement. It can make physical dealers more cautious. It can keep the stacking community in a bad mood. So no, I am not saying retail weakness means nothing. I am saying retail weakness does not equal silver death. That is a huge difference. And there is another piece people are missing. Recent numbers actually show that coin and bar demand can rebound even when industrial demand softens. So the retail story is not one clean straight line down. It is uneven. It moves with price, fear, confidence, cash flow, and headlines. That is why declaring the entire market dead from a few local anecdotes is just too simple. Now let's talk about price psychology for a second. When silver was much cheaper, people said, wait until silver finally breaks out. Then when silver broke into much higher territory, a lot of the same people started saying, well, I do not like it anymore because premiums are weird, dealers are mixed, and retail demand is not perfect. Okay, but that is how bull markets work. They do not make everybody comfortable. They shake people out. They create doubt. They move before consensus forms. And then, after the move is obvious, the crowd comes back and says it was obvious the whole time. No, it was not. This is why sentiment matters. Not because sentiment always drives price, but because bad sentiment at high prices can mean the public is still not fully involved. That is not the same as a top. A true mania usually feels different. Everybody agrees. Everybody is a genius. Everybody thinks the next leg is guaranteed. That is not the mood right now. The mood is suspicious, irritated, divided, and confused. That might actually be healthier than people think. Now, the bigger driver, in my opinion, is not whether a random shop had a slow Tuesday. The bigger driver is inflation. And inflation is not just a number on a screen. It is the slow leak in the tire. It is the extra cost in shipping, food, insurance, power, rent, fuel, and everything that touches energy. Recently reported inflation data showed the headline rate moving back above the low comfort zone, with energy jumping hard and gasoline making a very large monthly move. You do not need to memorize the exact figures. The point is that energy shocks feed into everything else with a delay. That is what people underestimate. At first it is gasoline, then it is freight, then it is packaging, then it is food distribution, then it is business margins, then it is the price tag at the store, and by the time consumers notice the full impact, policymakers are already behind the curve. This matters for gold and silver because precious metals tend to attract attention when people start doubting the stability of purchasing power. Not every day, not in a straight line, but over cycles it matters a lot. Now, the central bank has a problem. Recent policy language still describes inflation as elevated, and officials have been very clear that uncertainty around global conflict and energy can change the outlook. At the same time, markets are not exactly pricing in a return to brutal, old-school inflation fighting, and that is the box. If rates go much higher, debt service becomes painful. If rates get cut too soon, inflation psychology can reignite. If rates stay still while living costs rise, savers feel squeezed anyway. That is where real rates come in. A real interest rate is what you get after inflation takes its bite. And here is the important nuance. Some market measures of real rates are still positive right now, so we should not exaggerate and pretend every real rate is deeply negative today. But the direction matters. If inflation expectations keep rising while policy struggles to respond, the real return on cash and bonds can become less attractive quickly. That is when gold and silver start looking less like speculation and more like insurance. And people buy insurance before they need it, or they wish they had. Consumer psychology is already flashing caution. Recent surveys show confidence sitting near extremely depressed levels, while inflation expectations have moved higher. That combination is not healthy. It tells you households are not simply celebrating stock market headlines. They are looking at their bills. That is the real economy. You can have a stock index near a record and still have families feeling poorer. If groceries, gasoline, insurance, rent, and mortgage payments consume more income, then a higher headline market does not feel like prosperity. Housing proves the point. Some affordability measures have improved slightly from the worst moments, but that does not mean homes feel affordable to normal buyers. Prices, rates, insurance, taxes, and income all collide at the kitchen table. That is where financial stress becomes personal. And when financial stress becomes personal, people start asking different questions. Do I trust cash for 10 years? Do I trust bonds after inflation? Do I trust policymakers to protect purchasing power? Do I want at least some asset that cannot be printed? That is where silver comes back into the conversation. Not because it is perfect, silver is volatile. It can disappoint you, it can sleep for longer than you think. It can rise fast and then punish late buyers. It can be affected by industrial cycles, investment cycles, and liquidity. So let's not turn this into a fairy tale, but calling it dead while the macro backdrop is becoming more complicated is, in my opinion, too careless. If you're successful, share your success story in the comments so others can stay motivated. Now, the gold connection matters too. If capital rotates out of expensive paper assets and into hard assets, gold usually gets attention first. Silver often waits, frustrates everyone, then moves faster when the market decides to care. That does not mean every giant gold target should be treated like destiny. Ratio charts can be useful, but they are not crystal balls. They show what happened when investor psychology shifted in prior cycles. They do not guarantee the same road at the same speed. Still, the lesson is powerful. When trust in paper assets gets questioned, hard assets can reprice more violently than normal investors expect. And silver has one extra feature. It is small. The market is small enough that a meaningful investment wave can matter. especially if it arrives while industrial demand is still absorbing a large amount of supply and mine production cannot respond instantly. That is why the dead silver narrative is dangerous. It trains people to ignore a market that may be quiet on the retail surface while pressure builds underneath. And there is another supply-side detail people overlook. Silver mines are not software companies. You cannot press a button and double output because a chart breaks out. A lot of silver comes as a byproduct from lead, zinc, copper, and gold mines, so producers may not respond to silver price alone. If base metal economics are weak, silver supply can stay constrained even when silver buyers are more active. Recycling helps, but recycling is price sensitive and slow. Higher prices can bring scrap out of drawers, but they also scare jewelry buyers, pressure silverware demand, and encourage manufacturers to thrift. That is why the latest market picture is not perfectly bullish in every corner. Solar demand is dealing with substitution and thrifting. Some fabrication categories cooled. Jewelry has pressure when prices run hot. But that is exactly the point. Even with those soft spots, the market is still being discussed in deficit terms. That means the bear case cannot simply be, my favorite shop is quiet. You have to explain why global supply, industrial offtake, investment demand, inflation hedging, and regional physical tightness all stop mattering at the same time. That is a much harder argument. And until somebody makes that argument cleanly, I am not buying the funeral speech. And that is why patience matters here. The market can look boring on the surface while the foundation keeps shifting underneath. By the time everyone agrees the setup is obvious, the easy part of the move may already be gone. That is how it works. So here is the balanced version. American retail demand is not the whole silver market. Coin shops are not the whole retail market. Retail is not the whole demand picture. And even demand is not the whole price story, because price is also about rates, currency, inflation, positioning, and confidence. At the same time, weak retail demand is not something to dismiss completely. It is a sign that the public is not fully engaged. That can slow the move. It can make premiums less exciting. It can keep the market choppy. But if global demand stays broad, deficits continue, inflation pressure lingers, and real returns become less attractive, then weak retail sentiment could eventually flip from a bearish argument into dry powder. That is the part people miss. The buyer who is absent today can become the panic buyer tomorrow. The shop that is quiet today can have a wait list later. The metal that nobody wanted emotionally can become the metal everybody wants after the price already moved. So do not get hypnotized by the phrase, silver is dead. Ask better questions. What is total demand doing? What is industrial demand doing? What is mine supply doing? What are premiums doing in different regions? What are real rates doing? What is inflation doing? What are consumers feeling? What are policymakers trapped between? That is the actual map. And when you look at that map, silver does not look dead. It looks complicated, it looks misunderstood, it looks hated by the exact people who should be studying it more carefully. And sometimes, ladies and gentlemen, that is where opportunity hides. Not in the easy story, in the uncomfortable one. This is for education and perspective only. I am not your financial advisor, and I do not know your personal situation. Before you buy, sell, or hold anything, make sure the decision fits your own risk, timeline, cash needs, and common sense.